everyone, it's Friday and you're watching Within the Frame. I'm Kim Bo-kyung. Just this week, the Bank of Korea froze the key interest rate steady at 3.5% for the fourth consecutive time. This came amid easing inflationary pressure and a sluggish growth outlook. However, central bank left open the possibility of a rate hike in the future, as the U.S. Fed is widely expected to raise its rate by 0.25 percentage points at its upcoming rate-setting meeting. What are the specific reasons behind the BOK's rate freeze and when would a pivot come? For this, we invite Professor Kim Yong-jin from Sogang Business School. Professor Kim, welcome.
Good evening.
Good evening. And we also have Kang Min-joo, Senior Economist at ING. Mrs. Min-joo, thank you for your time.
Thank you for having me.
All right. Now, first question to our Professor Kim. Now, the Bank of Korea kept its key interest rate unchanged on Thursday at 3.5%. Was this decision widely expected?
Well, yeah. As you mentioned, the Bank of Korea, kept its base rate unchanged at 3.5%, holding the rate for the fourth consecutive time from February. Even though the central bank, left open the possibility of further, rate hike to 3.75%, in case of the U.S. Federal Reserve's rate increase. It was widely expected, due to several reasons, such as lowering inflation rate, weak export and trade deficit, and rising delinquency rate at domestic banks. As a matter of fact, the consumer price index fell below 3% in June for the first time in 21 months. The BOK projected this year GDP growth to be 1.4%, unchanged from May's forecast.
Right, I see. Now, since our Professor Kim mentioned how the consumer price index has fallen, why don't we get into the details on that first? So, Mrs. Kang, like our professor said, inflation in Korea rose by 2.7% in June from a year earlier, which is a 21-month low. Could we say inflationary pressure is clearly on the downward trend?
Yes, when we look at the headline inflation in Korea, compared to other major economies such as the US, EU, UK, and Canada, it is more obvious that Korea's headline inflation is steadily heading toward the target of the Bank of Korea's 2%. So, compared to the January's CPI number running at above 5%, now it's at 2.7%. So it is clear to coming down. However, when we look at the core inflation, excluding food and energy prices, it still stays in the 3% range, and also that the number hasn't come down as much as the headline did. So probably that is one of the reasons that the Bank of Korea continues to keep their hawkish stance in their monetary policy decision making. But we think that the other indicators such as inflation expectations or other pipeline inflations are indicating the inflation pressures will come down eventually. And also the core inflation tends to follow the headline with 3 to 4 months of time lag. So we believe that in over coming months we are going to see this core inflation will also come down to the 2% range.
All right, I see your point. Oh, now, Professor Kim, experts have pointed out another reason behind the rate freeze as being due to concerns over the financial soundness of the Korean Federation of Community Credit Cooperatives. Now, apparently there has been a run on the KFCC with some customers even withdrawing all their savings. Could you explain the situation for us?
Yes, basically this instance has been caused by KFCC's active lending to the real estate market, which is called project financing. If the real estate market is still good, then it wouldn't be a problem. But last year the market slumped, due to the economic downturn and the key interest rate hike. And these changes in the market condition affected KFCC's financial soundness negatively, and also. Of course, you already know the collapse of a lot of banks, like including SBB and Credit Suisse and other banks. According to the Ministry of the Interior and Safety, which oversees the Federation, the overall default rate of KFCC rose to 6.4 percent as of June 21, which is a sharp increase from the 1.93% recorded in 2021. The default rate for corporate loans recorded 9.99% as of March, more than quadrupling in 5 years. The probability of a bank run comes close, as some worried customers withdraw their deposit from the banks. From February to April, around 7 trillion won in deposit were withdrawn, decreasing the total deposit, to 258 trillion won from 265 trillion won.
Right, I see. So it is because of the slump in the real estate market. It does seem to be a serious problem. Now, Mrs. Kang, I'd like to ask you on this issue as well. What effect is this situation having on markets right now, and how might the BOK's decision to hold a key interest rate for now help to ease these concerns?
It seems like the market concern over a bank run event seems like stabilized quite a bit this week. However, we still see some volatile move in the money market. So the bond in the KTB market, we see some volatile movement, and also credit spread and widened a bit for the more capital companies. So, however, compared to what happened in last year, so the situation is quite manageable and it's not really concerning for now. The government and financial authorities stepped in, and also they put all possible some of the options on the table from the very beginning, and so they do not want this issue will escalate further, and probably they also learned from the last year's experience that how things could go wrong if they didn't respond in time, and it seems like these measures are kind of working to calm down the market anxiety and uneasiness. And also the BOK side, the governor Lee Chang-yong also mentioned that press conference yesterday that if necessary, the BOK will provide some market liquidity through their facility lending to this MDCCC. So they are also provide more the market liquidity to the market. So we believe that with all this kind of policy support, this event will it will not escalate further from now on.
Right, I see. I mean, it's good to hear that the situation is manageable right now and that the government is trying to step in to solve this issue. Now, Professor Kim, another reason behind holding base rate at the current level is, of course, worries over the country's growth, as the finance ministry recently revised down South Korea's growth outlook to 1.4% from the previous 1.6%. Now, is it possible we might see any signs of economic recovery for the latter half of this year?
Well, unfortunately, I don't think there would be an economic recovery soon in the second half of this year. There are many unfavorable factors, which influence the economic recovery. First of all, the sluggish export, performance and domestic consumption, and high household debt level and high inflation rate, and also high interest rate. In particular, Korean economy greatly relies on export, but the foreign market condition won't be better in the second half of the year. The final demand from the U.S. and EU is expected to weaken, and China's reopening will not provide meaningful stimulus to the global economy. In sum, global demand conditions won't be favorable for Korea's export to fully recover. The most important problem would be the U.S. economy. Now it looks solid, from various aspects like, domestic consumption and unemployment rate. But, the economic recession of the U.S. is expected to start the first half of next year, which means, Korean economy will suffer the lack of demand until, first half of next year. So the economic recovery will be very much not expected.
I see. So it does seem like the U.S. economy is what really matters, and thus we cannot overlook the much anticipated Federal Reserve's decision coming soon. And so, Mrs. Kang, recently a key inflation report on the state of the U.S. economy has been released. And what did you make of the 3% inflation figure?
Yes, actually, the U.S. inflation slows to 3% year-on-year terms. And we see more broader signs of price moderation, and both headline and core rates undershooting the market expectations as well. Also looking at the details, actually the rent price still went up very solidly. However, outside of the rent, everything else, the price was quite soft. We believe that this trend will not continue because of the base effect. So we're going to likely see the reacceleration of the headline inflation. However, at this moment, the market is relieved that the inflation number came down to the 3%. So it seems like the Fed's aggressive rate hikes kind of finally working to kill some of the inflationary pressure.
Right, so market is relieved for now, but Mrs. Kang, one more question. Though inflationary pressure has definitely cooled off, as we can definitely see, the figure remains above the Fed's 2% target rate. And is it right to say that the Fed will go ahead with yet another rate hike at its next rate-setting meeting that is going to be soon?
Yes, actually, 3% is not good enough for the Fed to, for preventing a July hike, we believe. And also it depends on, the coming inflation number and coming labor market number. Actually, we still have to open the door for another, second rate hike beyond July. And as I mentioned earlier, because of this base effect, we are going to see this headline inflation will go up above 3% again. Then, we have to carefully see how the Fed will react on these numbers.
Right, we'll have to wait and see what kind of decision Fed makes. But Professor Kim, if the Fed does deliver a rate hike by a quarter percentage point to a range of 5.25 to 5.5%, the rate gap between South Korea and the U.S. would widen to 2 percentage points.
Right.
Would that in any way affect future BOK's rate decisions?
Yeah, before we get there, I think if the Fed would increase the base rate 0.25 next month or so, then at the end of the year, the U.S. economy would be affected. So that's why I'm saying the U.S. economy would have a recession next year, the first half of next year. Now that is, and also absolutely, if the Fed increases the base rate by a quarter percentage point, as you correctly mentioned, the interest gap between the U.S. and Korea would be 2 percentage point, which we have never experienced. We don't know what will be happening if the BOK keep the rate same. Probably the foreign investors will sell their assets in Korea to move to buy those of the U.S. Then the value of Korean won will drop dramatically, which in turn may cause just like in a hard currency crisis. To avoid this kind of situation, the BOK will seriously consider the effect of the interest hike done by the U.S. Fed. To me, if the U.S. Fed raises the base rate, then the BOK has to follow to increase it at the same amount.
Right, so our Professor Kim is expecting the BOK to follow suit the Fed's decision. Professor Kim, one more question here. It looks like there is a relationship between interest rate and currency issue, but for those who might not be familiar, how is currency volatility related to the central bank's decision to raise the base rate? And will the $1 exchange rate actually remain stable?
Well, okay, it is quite simple to understand the relationship between the interest rate and the exchange rate. If we keep in mind, two things. The first, the interest rate is the revenue from the money, and the exchange rate is the result of demand and supply. If the U.S. Fed increases the base interest rate, it means the revenue from U.S. dollar increases. So investors need more U.S. dollars, less Korean won, to invest in U.S. dollars. This is because investors want to invest in assets which give them more revenue. If the demand for the U.S. dollar rises to get a dollar, foreign investors will sell Korean won to buy U.S. dollar. So the value of Korean won drops, and that of U.S. dollar goes up. To avoid this situation, as the U.S. Fed raise the base rate, the BOK need to follow it to raise the interest rate too. That's my explanation about it.
All right, thank you, Professor Kim. Now, I believe this will be our last question, but though a BOK governor left the possibility to go on with another rate hike, some experts are expecting pivot to take place, and so I'd like to ask both of our experts about this. Mrs. Kang, could you tell us when the pivot might start?
Actually, we expect the BOK will make its first move to cut the policy rate in sometime in the fourth quarter of this year, because we believe that the headline inflation number and core inflation number will hover around 2% by the time, and also the restrictive rate condition lasts more than a year, then household consumption and also the investment will likely be hampered. So I think, then, probably the BOK has to consider the easing, monetary policy, because also at the time, then, the, U.S. and probably the EU also, the slowdown in demand, global demand, then, the BOK will likely support the household and business, to, by easing monetary policy to absorb the shock from the global, demand slowdown.
I see. Professor Kim, what's your point of view?
Well, it is kind of, hard to expect. Basically, the BOK has been doing its job very excellently, so far. It must have been tough decisions to keep the interest rate, same for the fourth consecutive, time, while the U.S. Fed increases the base, rate. Korea has its own very unique situation. We have very high household debt, compared to other OECD countries, also, including U.S. and even Japan. Also, Korean economy relies on the export for the economic growth. Keeping the base rate low is very important for the Korean economic growth. Well, I don't think, the BOK has, much opportunity to lower interest rate, soon. But I hope the BOK balance the factors to help, the economy grow amid the unstable global economic condition.
Right, I see. It seems like BOK would have to keep facing dilemma regarding this rate decision. All right, unfortunately, this is all the time we have for today's edition about Professor Kim and Mrs. Kang. Thank you for your insights and for your time. Really appreciate it.
Thank you for having me.
Yep.
Thank you. All right, that's all for Within the Frame tonight. We'll be next Monday with more in-depth stories. Thank you for watching. Enjoy the weekend and goodbye.